Today we are going to explain a HELOC, that is Home Equity Line of Credit. Now before we dive into that, if you haven't subscribed, please do. Don't forget to hit the like button and also the bell to be notified every time new videos drop, which is every single week. My name is Stephanie Weeks and I've been helping people with their mortgage financing for over 18 years, and the Weeks team would love to help you as well. We can be reached at 985-300-LOAN. That's 985-300-LOAN. Now, enough about that. Let's dive into the topic. HELOC, Home Equity Line of Credit. We want to talk about information as far as how it's going to affect your credit score, how does it work, how might the monthly payment be, when it's going to be a good time to use a home equity line of credit, and then we'll just barely touch a little bit on how it's different from a loan, okay, and the benefits of the two. So what we're going to do first, we're going to kind of define a HELOC. A HELOC is basically a line of credit against the equity of the home. Now, according to Brian Buffini, and I think he got this from the NAR website, in 2021, the average homeowner got an increase in equity of, are you ready for it? $57,000. Yes, $57,000. So that's huge. So with that, a lot of people are cashing out and they're selling their houses and they're taking the money and doing whatever. And some other people are saying, well, maybe now's a good time to take advantage of this equity and pull some equity out to maybe consolidate debt, put in that pool, do that renovation, send my kid to college, whatever it might be. And see, in the not so distant past, when rates were lower, it might make sense to do a cash-out refinance. And listen, there are some of you out there who still would benefit from a cash-out refinance. But let's assume just some average things, and I'm not quoting interest rates, I'm giving you a scenario. Let's say that you have your mortgage at 3.5% interest, and now the rates are 4.5% interest, and you want to pull out $50,000 for a renovation. And you're thinking, you know what, I can probably pay that $50,000 off in the next 5 years. Well, you're not going to want to take your full mortgage balance at 3.5 and bring it to 4.5 to just get 50 grand that you're going to be able to pay off in 5 years. So in that instance, that might be a good example of where a HELOC might work. Maybe home equity loan might work depending upon your situation, or maybe even pulling a loan against your retirement as well. Now, we're not talking about that in today's video, but I just want to try to share with you anything I can think of to help you get that money that's going to help you. So let's talk about that home equity line of credit specifically. So for the first 10 years of your HELOC is called the draw period, where you can draw money in and out. Now, think of it like a credit card, because it does have a limit like the credit card does, okay? And you can possibly write a check, or I mean, sometimes you can't write a check from a credit card, but you can like write a check. So let's say you have a $50,000 line of credit. Let's just use $100,000, okay? You have a $100,000 line of credit, and if you don't owe any money on it, then you don't pay any interest and you don't make a payment. I'm going to say that again. If you do a home equity line of credit for $100,000 and you don't draw any money on it yet, you don't pay interest, and you don't pay a monthly payment. Now, if you did a home equity loan for $100,000, well, that money is given to you, it's put into your account, and you're going to start making payments right away. What would be an example of wanting the difference? Well, let's say that you're getting $100,000 because that's what you expect to pay to send your child to college over the next 4 years. Well, but you only need $25,000 each time, and you're going to pay it down as fast as you can. Well, that's great, because the first year you've got 25 grand, and so you'll be paying payments on the 25 grand and paying interest on the 25 grand. And then maybe year 2, you're up to 40 because you paid down 10 and then you needed another 25. So things like that. Now let's talk about the payment. With a home equity line of credit, typically there are 2 options with payments, and they affect your interest rate. If you want to get the lower interest rate, then you're typically going to be asked to make a 1% payment. So let's use our $100,000 again. Let's say that the $100,000, you've drawn all of it, okay? And your balance is $100,000. Well, then that means at every single month, you're gonna owe $1,000. That's gonna be your payment. Now, if you wanna do interest-only payments, which a lot of people choose, you're gonna pay a little higher on the interest rate, and then that payment is gonna be based on the balance. Again, let's use $100,000. $100,000 loan, home equity line of credit, 5% interest, that minimum payment would be about $416 and change, and you would only be paying back interest in that. You would not be paying down any principal if that's the payment that you choose to make. So let's use an example of a line of credit versus a lump sum, another example where it might make sense. Let's say that you are considering doing a renovation and it's gonna cost $100,000. And it's gonna take a while because materials and everything is really backed up. So it's not just gonna be like you're just gonna write a $100,000 check and there you go. It might be month one where you have to write a $10,000 check, and then month two, now you've drawn out $30,000, and so on and so forth, right? So it's gonna take you a few months. Well, it's great because you're gonna be able to make those payments based on the balance versus, again, that lump sum at once where it's just gonna be, go ahead and just be dropped into your account. Now let's talk about the interest rate difference. We talked about a HELOC that might have two options, one being the 1% payment option with the lower rate, one being the interest-only payment option with the lower rate, and then you've also got your fixed home equity loan that is the one big lump sum, and most of the time that is a lot higher of an interest rate, and I bet you're wondering why. Because these first two options are based on the prime rate of money plus a margin, and it's adjustable. So these are not fixed rates. Whereas if the actually closed-in home equity loan is a fixed interest rate at a fixed loan amount at a fixed monthly payment. So you really want to take those things into consideration when you're trying to decide which is going to be better for you. Now, a HELOC is going to require a hard credit pull. They want to pull your credit to make sure that you're going to qualify and make sure that you have the ability to repay and the likelihood to repay. So they're going to do a hard credit check. There are so many misconceptions right now about hard credit checks for mortgages and what that looks like. And so many people are scared to pull their credit to get pre-approved, and it is blowing my mind because it's like telling me, hey, you're my dentist and my tooth hurts and I need you to fix it, but I'm not coming in and don't look at it. Well, that's what you're asking the lender to do if you're like, hey, can I approve for a mortgage, but I don't want a hard credit pull because it might affect me. Well, number one, we can't run the approvals, DU, LP, FHA, GUS, that doesn't mean anything to you, but these are different approval systems that we use. Those don't allow us to run approvals if we don't have hard credit pulls. Besides the fact, and I'm not gonna go for a long tangent, I'll drop some links below. I've also done a few different lives on Facebook and my Massive Mortgage Education Facebook group about these things, because if you're not having a lot of people pull your credit for a lot of different reasons in a short period of time, it is not going to affect you at all to have someone pull your credit for a mortgage to see what you approve for. Now, coming back, gosh, the wind is going crazy outside. I'm seeing pillows blowing that way back and forth. In case you see me looking, that's what is going on. The pillows are just like zoom, zoom, zoom. The bad weather is apparently coming today, and hopefully it's going to be fine, because last week it was not fine and there were a lot of tornadoes and a lot of people got a lot of damage, lost homes, and even one person actually passed away. So I'm hoping that today's weather, please not be so bad as last week's. Anyway, so they're gonna pull your credit. It's gonna be a hard credit check. And with the HELOC, instead of with that fixed loan, it's gonna show on your credit as a revolving account, just as if a credit card would be reporting as a revolving account. And what you have in usage versus what you have in availability is what is going to affect that credit score positively and or negatively. And think about this. I don't know the average credit limit, okay? But I'm gonna assume it might be $10,000, okay? Taking an average. And I might assume that maybe the average home equity line of credit is $50,000, but I've seen it be $400,000, so it's a big difference, right? So if you've got this home equity line of credit on your credit for a long time, and you've got a small utilization in relation to the availability, okay? And now you close that. That's instantly going to have an impact on the percentage of utilization of availability because it's got that large limit, right? And so it's going to have a negative impact for some type of short period of time when you do end up closing those home equity lines of credit. I bet you're wondering how else a home equity line of credit might affect your credit. And of course, it's going to be how long you've got it open. It's going to be that utilization like we talked about. It's also going to be missed payments. Listen, the biggest thing I have noticed is if you want to really bomb out your credit, if you've had beautiful, perfect credit, no mistakes, your entire 25-year credit history, and you decide to pay your line of credit, your home equity line of credit, or your mortgage late, 100 points. I have seen the score drop 100 points, and a recent mortgage late can cause you to not get a new home loan if you're in the middle of trying to sell and trying to buy. So that credit's very important, and the pay history is very important, and how you handle that pay history on those mortgages and that line of credit is also going to depend on how your credit is going to be affected negatively or positively. Now, a HELOC might be right for you and it might be wrong. Here are some other ideas of instances where it's made sense for people to get home equity lines of credit. In this market especially, it's crazy, right? And I'm sure that you would agree, and the realtors would agree, and please comment below, that cash is king. So if I've got 10 offers that come in and they're all relatively close to each other, and 9 of them are financed and subject to appraisal, one of them is a little bit lesser of a sales price amount or an offer amount, but it's not appraisal contingent, it's a much faster closing, and there's no financing involved. Who are you going to take? Probably the cash offer. Well, if you own property and you plan to buy other property and you have enough equity in your house to where if you don't need it, you open it and you're not using it. But let's say that perfect house comes along and you want to make sure to win that bid. Well, a home equity line of credit would be great because hopefully it'd be enough to take and literally write a check, aka cash, to close on that new home not subject to financing, and you might be able to win that home. Maybe it's the home of your dreams. Maybe it's the fourplex you've been really wanting to invest in. Maybe it's a second home, or maybe it's just an investment property. But that would be a really great utilization of a home equity line of credit. Or like I said, if it's more of a short-term type of financing. Let's say that you went online and you needed a $50,000 loan, and you knew that you were going to pay it off in 3 years or less, and you wanted a good interest rate and you wanted some flexibility with the payments. Well, if you go online and you just try to get an unsecured loan, I mean, I don't know, I don't do those, but I'm going to guess you might pay 7 or 8% interest. Well, what if you can get a HELOC at a 5% interest rate? Maybe it's below 5. I'm not sure about that because I don't do HELOCs either, but you're getting the point of that. It just might offer more flexibility. Or I'm sure I'm leaving off a lot of suggestions or a lot of possibilities where it might be good for you, but here's another one. You know, we talked about that renovation or that pool. I mean, maybe that pool company needs a deposit of $15,000, but they're not going to get to you for 4 months. Well, why would you get a loan that's going to drop all that money in your bank account from day one at a higher interest rate, payments starting from day one based on the full loan amount that you might not need to actually have drawn for 6 months while they're trying to complete that pool construction? So just something to think about. I hope this has been helpful. Please leave me a comment below. Don't forget to like and subscribe. Call us if we can help with your financing at 985-300-LOAN. And I really hope to see you in the next video. Now, if you're wondering more about mortgages in addition to HELOCs, in addition to second mortgages, things like that, did you realize that over 21 million people a year, on average, apply for mortgages and only 7 million close? And guess what? That is not because only 1/3 of people approve. It's because of lack of information, miscommunication, lack of accurate information, and such massive confusion when you try to go and Google something, because there's so much that goes into a home loan and a home loan approval. So if you're tired of that, or you're nervous about that and you don't know where to start, or maybe you've been denied and you're just frustrated, I have actually built the perfect mortgage course. It goes along with my massive mortgage education Facebook group. and it's available for sale. I'll drop the link below. I've got it for sale right now only for $97 with this particular link. It's usually a lot more than that, and it'll take you step by step, even as far as going to how to put the perfect loan package together.
The Weeks team would love to help you with your mortgage financing in Louisiana, Mississippi, Alabama, and Florida. We want to be your loan officer.